Welcome to this video day. It is the 15th of April. So our update outlook for the Australian dollar against the US dollar. Also look at the Aussie on some crosses as well. And we view this, and have done for a while, as one of the best trends on the board. We've been following it down since 93.50. We've got a target of 65 on the downside, and we expect that to be hit in the next few months. So although we've fallen a long way, there's still plenty of downside potential. And the Aussie is a very simple trade for trend followers to understand and do. The fundamentals are not turning around, and they are going to drive the price lower on the charts. Now, in terms of recent weeks, we've seen some sideways action in the Aussie. We've sort of gone into a little bit of a channel. Now, I think that channel is about to end. So let me just look at the technical levels first of all, then we'll go on to the fundamentals and why we think a break is coming pretty quickly. Now, if you look at the levels themselves, the obvious one is the recent chart low at 75.30. If that gets taken out, get below 75, next leg of the downtrend will be on the way. If we rally, levels of resistance are clear to sell back to. You can sell back to the 77 level. That's the 20-day moving average. And I think we could run that 20-day moving average. We'd certainly face stern resistance at 78, and that's presently the level we've got our stop behind at 78.50. But a rally is a sell, and so is a break lower. Now, if you look why the channel emerged, it was basically too many speculators were short the Aussie. You could see that on the CFTC net traders position. The recent sideways choppy action has taken them out, and the Aussie is no longer oversold. In terms of the fundamentals that pushed the Aussie up recently were basically, the RBA held rates. The market consensus was for a cut. So again, that meant more speculators got taken out on the stop. Now, in terms of the data coming out of Australia, we've got unemployment tomorrow. There's no doubt in our mind that unemployment is going to get worse in Australia. It's being called an unchanged jobless rate. Let's say we get a number slightly better than expected. It will not give the Aussie much of that rally in our view. If we get a bearish surprise, I think we'll break down. Now, in terms of data today, we had that GDP number out of China, and the Aussie held up quite well, 7%, and that's the slowest annual growth in 6 years. Now, it was expected by the market, so we didn't really expect any reaction. But the number itself is totally manufactured. It's right on the government target, and it isn't correct. Things are far worse in China than many people believe. I'm going to give you an extraordinary situation in China in a moment. But in terms of the internals in Australia, there will be more interest rates coming if needed. The RBA have already said this. The only reason they held them is they want to see if the market can bring the Aussie down. They want it down below 70. The market doesn't bring it down, they will. They're just a little bit reluctant to cut rates for that housing bubble and a lot of consumer debt, but they will cut if necessary. Australia faces the worst terms of trade now for 50 years. And, if you look at the fall in commodity prices that Australia exports, they're massive falls, and these commodities can be falling further. We've seen coal halved in price. Iron ore, Australia's biggest export, down from $130 a tonne to just $50 a tonne. It's going to go down more. Obviously Australia is exporting to China. I've just mentioned that GDP number. It cannot be right. If you look at the data that's been coming out of China recently, it's very suspicious. It's right on the government target. We've seen this before. We saw exports down 14% for last month against a market call for being up 12%. The market remains far too bullish of China. Now, China knows it's got problems, but it's going to be very, very hard for China to avoid, a crash now. And what I want to just bring into focus here is something that's going on in the Chinese stock market. And traders aren't really paying attention to it. It's got all the hallmarks of a bubble crash. All you have to do is go and look at the Shanghai Composite Index. It's moved up from around 3,400 to 4,100 in a month. That is an extraordinary rise. What has caused the rise? There's actually encouragement for Chinese people to just go into the stock market. 1.8 million new brokerage accounts were opened last week. And, surveys of these brokerage accounts shows they're mostly illiterate people who do not know what they're doing. It's just a bubble. Now, the valuations are what was really interesting about the Shanghai Composite. In the dot-com bubble in the States, obviously that all ended in tears. Well, in the Shanghai Composite, it's actually double the valuations of companies that went down in the dot-com bubble. You have got deer antlers for health companies. 70 times earnings they're trading at. There's one that I think is a ketchup company and another a school uniform company, 330 times earnings. That is a bubble, just like the dot-com bubble we saw in the States. Now, the problem here is that this all has to end. These bubbles just have to end. And you've got the housing bubble as well. You've got this stock market bubble going on. You've got, obviously, exports falling in China, no domestic demand. It is just basically, cash-driven, and it's debt-driven. If you look throughout history, when you actually produce as much credit as the Chinese have had over the last few years, it ends in a crash. There is no easy solution for China. In fact, I can't see a solution at all. It's going to start to really, really, get to a serious situation in the next few months, I think. It's just that Shanghai Composite, just looking at it today, just get a chart out and look at just how it's moving to the upside. It's a bubble. So obviously with the China situation, it's already worse than the official numbers, okay? And, it's just going to get even worse. Now that is really going to keep the pressure on the Aussie. Also, on the other side, over in the States, people are talking about the US putting up interest rates in September. We've made it clear in our weekly forecast, everything points to June. So, the Aussie looks like it's going to be going down to 65. Sure, it's been a great trend, and it's made us a lot of money. However, we still think there's plenty more room on the downside. So it's a question of, selling those pops higher or the breaks lower. And I think, with the technical picture, it's always easier to have a target that is quite a long way away. When we set our target, it was a long way off 93.50. If you know the big fundamentals. Big fundamentals do not turn around quickly. They drive the charts. Price spikes within the big trends are obviously just sentiment. When the Aussie gets a low result, it's got a bounce, for example. But at the end of the day, this is a great, solid, long-term trend for trend traders. And it's an easy one to do and get in on. Obviously, you can't have your stop within 50 pips, but you can't do that in trend following. You should never do it, really. In any trend you're looking to make a lot of money out of. But this great trend for us, we think it's going to continue. Now, in terms of on the crosses, we like the Aussie dollar short on the Japanese yen. Any problems in China or anywhere else are really going to push the yen higher. And also we think, in terms of Japan, they've made it clear now, fair value for the Japanese yen in their view is 105 on the USD. It's a long way from there. They've made it clear they're not printing any more money, and we're getting some decent numbers out of the economy. But safe haven flows will be driving the yen as well. So that's a good cross to keep your eye on. We also like it short on the Canadian dollar. Canadian exports will hold up far better than Australia's. Canada is exposed to the US, which is doing far better than China. We're oversold at the moment, so wait for a bounce to the 20-day moving average. And the other one I quite like the look of on a bounce to the 20-day moving average is the Singapore dollar. So far lower prices in the Australian dollar, and we think that 65 target could be hit pretty soon. Thank you very much for watching me as per usual. Email me with any questions or queries at any time, and check weekly forecasts for updates on this trade. Thank you. Have a good day.